Welcome to Charged Alpha. I'm Hudson Thomas here with Lana Chen, and today we are breaking down WABTech, ticker WAB, which just delivered what is arguably the cleanest print we have covered this earnings season. Revenue of $2.95 billion, up 13% year over year, a Q1 record. Adjusted EPS of 271, up nearly 19%, and a backlog that now sits at $30.8 billion.
That backlog number is the one that stops you. Up $8.5 billion year over year and 36.2% ex-FX. For a company doing roughly $12 billion in annual revenue, you are talking about more than 2.5 years of orders already on the books.
And they beat the street by $70 million on the top line, 9 cents on the bottom, and still had the room to walk guidance higher for the full year.
Adjusted EBITDA margin of 24.9%, up 170 basis points. Freight segment operating margin at 26.0%. This was not a mixed quarter dressed up as a beat. The quality underneath matched the headline.
So today we are going to walk through what WABTech actually does, why Rafael Santana's playbook is working, whether the valuation still makes sense at $266 a share, and where the bulls and the bears genuinely disagree. Let's get into it. Lana, for listeners who do not live inside the industrials universe, WABTech is one of those companies you interact with every day without realizing it. Every time a freight train rolls past your car at a crossing, there is a very good chance WABTech technology is on board.
The company traces its roots to George Westinghouse's air brake invention in 1869, which standardized rail braking in North America. The modern WABTech as we know it was formed through the 2019 merger with GE Transportation, which is how they absorbed the locomotive business.
And that matters because it reshaped the revenue mix. Today, WABTech runs two segments. Freight, which did $2.1 billion this quarter at a 26% adjusted operating margin. That is locomotives, aftermarket services, digital electronics, and components for Class 1 railroads. Then Transit, which did $938 million, up 17.8%. That is passenger rail, subway cars, commuter rail, light rail systems globally.
Think of freight as the engine room and transit as the global platform. Freight is dominated by the big North American railroads, Union Pacific, BNSF, CSX, Norfolk Southern, Canadian National. Transit is much more international, with customers across Europe, India, Brazil, and Asia.
The analogy I use is that WABTech is to rail what Raytheon is to defense electronics. They do not build the whole train, but they build the nervous system, the brakes, the propulsion controls, the software that optimizes fuel burn, the predictive maintenance telemetry. It is deeply embedded, hard to rip out, and it compounds over decades.
And the Dellner Couplings acquisition that closed this quarter, roughly $1 billion in price, extends that embedded footprint into passenger rail coupler and door systems. We will come back to that.
The CEO running this story is Rafael Santana. He has been in the seat since July 2019, which means he took over right as the GE Transportation merger was closing. Lana, walk through how he got there.
Santana is a 20-plus year GE veteran. He ran GE Transportation as president and CEO from 2017 to 2019, so when WABTech acquired that business, he came over with it and took the combined company's top job. Before that, he held senior roles across GE's industrial and energy divisions in Latin America, Europe, and the United States. Electrical engineering degree from the Federal University of Uberlandia in Brazil, and an MBA from INSEAD.
What I respect about Santana's tenure is that he did not try to rebuild the company in his own image. He inherited a merger integration, he executed it, and then he tilted the portfolio toward higher quality revenue. Digital services, Trip Optimizer, positive train control, predictive maintenance, those are all growing 15 to 18% annually now at 70% plus gross margins.
He also pushed international growth hard, particularly India and Brazil, where the rail build-out programs are enormous. And the Dellner deal is classic Santana. Tuck-in that expands transit globally, adds European manufacturing, and slots into the existing customer base rather than opening a new front.
The results are the scoreboard. Backlog up 36% ex-FX, margin expansion across both segments, and another guidance raise. That is a CEO who has earned the benefit of the doubt. All right, let's talk about price. The stock is at $266.61. Market cap just over $45 billion. The 52-week range runs from 157.20 on the low end to 298.44 at the high. So we are sitting about 11% below the high after this print. Lana, is this cheap or expensive?
Trailing PE is 39.1x on a GAAP basis. That sounds rich in isolation, but the forward EPS projection for 2026 is $10.45, which pulls the forward PE down to 25.5x. The 2027 forward EPS projection is $11.82, and the 2028 forward EPS projection is $13.25. So if you underwrite the growth algorithm, the multiple compresses meaningfully as the earnings stack in.
EV.
17.4x on a trailing basis. Price to sales is 4.05x. Both are at the upper end of where WABTech has traded historically, but they are not stretched when you benchmark against the growth profile and the backlog visibility.
So the question every investor asks after a beat and raise like this is whether the good news is already in the price. My read is that 25.5x forward for a company compounding EPS at roughly 17% with a $30.8 billion backlog is not expensive. It is fair. It is not a discount anymore, but fair is still investable if the algorithm holds.
The beta is 1.18, so you're getting slightly more market sensitivity than the S&P, which matters for position sizing. But the valuation story is not about whether this is a value stock. It is about whether the growth is durable enough to support the multiple, and the backlog argues that it is.
Fair is the right word. Fair with upside if freight margin holds. Let's get into the actual print. Revenue of $2.95 billion beat by $70 million, up 13% year over year. Adjusted EPS of 2.79 beat, up 18.9%. GAAP EPS came in at 2.12. Net income of $358 million. This was a Q1 record on both lines.
The margin line is where the quality shows. Adjusted EBITDA of $736 million, which is a 24.9% margin, up 170 basis points year over year. Adjusted operating income of $628 million, 20.3% margin. Freight did $2.2 billion in revenue, up 11.3% at a 26.0% adjusted operating margin. Transit did $938 million, up 17.8%.
Transit growth outpacing freight is a story worth pausing on. Transit has historically been the lower margin, lumpier segment. But 17.8% growth tells you the international passenger rail cycle is real, and Delner closing during the quarter gives them another lever there.
The backlog detail is the other headline. Multi-year backlog of $30.8 billion, up $8.5 billion year over year, or 36% ex-FX. The 12-month backlog is $7.1 billion, up 12.8%. That 12-month number is the one that translates directly into near-term revenue conversion.
And then the guidance. Full year 2026 revenue now at $12.09 to $12.49 billion, midpoint $12.34 billion. Adjusted EPS $10.25 to $10.65, midpoint $10.45, which implies roughly 17% growth year over year. Adjusted EBITDA $296 to $304 billion.
That is a raise from where the street was modeling coming in. The market reaction, stock holding near the 52-week range highs, reflects the beat, the raise, and the backlog all pointing the same direction. When those three line up, multiple compression does not happen. Multiple support does.
Clean print, clean raise, clean backlog. That is the tape. Lana, where does the street stand on WABTech after this print?
Consensus is a buy. Out of 25 analysts covering the name, 18 have buy ratings, 6 are hold, and 1 is sell. The average price target is $281, which implies roughly 5 to 6% upside from current levels. That tighter spread tells you the street has largely caught up to the story.
Who is the most bullish and who is the most cautious?
RBC Capital Markets is carrying the high target at $295 with an outperform rating. Citi moved their target to $292 post-earnings with a buy. Morgan Stanley is overweight at $285. On the more cautious side, Wells Fargo is equal weight at $284 and Barclays is equal weight at $265, which is actually below the current trading price.
So Barclays is the bear in the room. What is their hang-up?
Their concern is largely around Class 1 railroad capex sensitivity and whether the margin expansion trajectory can continue at this pace without tariff headwinds on steel and aluminum catching up. Fair concerns, but they are the minority view.
The setup is constructive but not ebullient. A buy consensus with a $281 target on a $266 stock is not the street screaming upside. It is the street agreeing the story is intact. That is a different risk profile. Let's open the balance sheet. Lana, walk me through it.
Cash of $530 million, total debt of $6.54 billion, net debt of $6.1 billion, net leverage sits at 2.3x EBITDA against a management-stated ceiling of 3.0x. Total assets are $19.8 billion, stockholders' equity of $9.54 billion.
So they used balance sheet capacity to buy Dellner for roughly $1 billion this quarter and still sit at 2.3x. That is manageable.
Cash generation backs it up. Operating cash flow on a trailing 12-month basis is $2.28 billion. Free cash flow is $1.68 billion. That is high-quality cash conversion. Roughly 73% of EBITDA flowing through to free cash.
What about capital return?
The annual dividend is 60 cents per share, which works out to a 0.23% yield. Payout ratio is only 5.7%, so there is obvious room to grow it. Share buybacks totaled $450 million over the trailing 12 months, and there is $1.2 billion remaining on the current authorization.
So the capital allocation story is roughly fund organic growth first, tuck in M&A second, Dellner being the current example, buybacks third, dividend fourth. That is the right priority stack for a backlog-driven compounder.
The balance sheet is a strength with guardrails. 2.3x leverage gives them room for another sizable deal if the right one shows up, but it does not leave them invulnerable if Class 1 CapEx softens. Management's 3.0x ceiling is the line to watch.
Let's frame the bull case around 5 pillars. Lana, take us through them.
Pillar 1. Backlog conversion. The $30.8 billion multi-year backlog, up 36% ex-FX, paired with $7.1 billion in 12-month backlog, gives WAB revenue visibility that stretches into 2029. Very few industrials can say that.
Pillar 2.
Dellner integration. The $1 billion acquisition adds passenger rail coupler and door systems running at 20 to 25% EBITDA margins. And WAB can cross-sell that product into 1,500-plus existing transit customers globally. This is accretive both financially and strategically.
Pillar 3 is my favorite structurally, the locomotive modernization cycle.
Exactly. Class 1 railroads are replacing aging diesel fleets with WAB Tier 4 locomotives and hydrogen-ready FLX drive models as EPA emission mandates tighten through 2027. The regulatory calendar is effectively a demand driver.
Pillar 4.
Digital services recurring revenue, Trip Optimizer, Positive Train Control, and Predictive Maintenance are growing 15 to 18% annually at 70% plus gross margins. This is the highest quality revenue in the model, and it compounds.
And Pillar 5.
International expansion. India and Brazil rail build-out programs collectively represent roughly $40 billion in CapEx opportunity over the coming years. And WAB already has initial locomotive contracts in both markets. That is optionality on top of a North American core that is already growing.
5 pillars. And the interesting thing is that they reinforce each other. Backlog feeds visibility. Visibility funds digital investment. Digital lifts margins. Margins fund M&A. M&A extends international reach. It is a flywheel. Now flip it. What is the bear case?
5 risks. First, Class 1 railroad CapEx sensitivity. Union Pacific, BNSF, and CSX collectively drive around 40% of freight revenue. If any of those three pull back on CapEx tied to volume softness, WAB takes the hit directly.
That is the concentration risk. What is next?
Steel and aluminum tariff exposure. Locomotives and railcar components are steel intensive. If tariffs drive input cost inflation faster than contract repricing cycles can absorb it, freight margins compress before the pass-through catches up.
Push back on me here. Is that not something they have navigated before?
They have, but the magnitude matters. A 200 basis point margin compression in freight translates directly into the EPS line, and at 26% margins, they have given themselves room but not cushion.
Third risk?
Dellner integration execution. A $1 billion acquisition brings European operations and roughly 2,400 employees into the fold. Integration costs, cultural alignment, and operational standardization are a 2 to 3 year execution challenge.
Fourth,
Leverage. Net debt of $6 billion at 2.3x is manageable today, but it leaves limited cushion if revenue slips below plan. Management's ceiling is 3.0x, which would trigger capital allocation changes, fewer buybacks, potentially slower M&A.
And the fifth risk is the one that does not get enough attention.
CRRC. China's state-backed rail OEM is bidding aggressively on international transit contracts, often below market price. That threatens WABTEC's positioning in emerging markets where price sensitivity is higher.
The central bear thesis, if you stitch it together, is this. WABTEC is priced for flawless execution across a North American CapEx cycle that may be peaking, a European integration that is just starting, and international markets where a state-backed rival can discount on a scale no Western company can match. That is the bear's mountain to climb. Let's talk about rivals. How does WABTEC stack up on the comp sheet?
Starting with the direct rail rivals. Trinity Industries, ticker TRN, has a market cap of $2.52 billion, trades at 0.98x price to sales, and is growing revenue at 4.2%. Greenbrier, ticker GBX, is $1.44 billion market cap, 0.50 PS, revenue down 23%. Both are railcar manufacturers, not locomotive and systems providers, which is a key distinction.
So Trinity and Greenbrier are in the supply chain, but not in the same business. What about the broader industrial rivals?
Caterpillar trades at 2.18x price to sales, with revenue down 10%. ITT trades at 1.37 PS, with revenue up 6.8%. WABTEC at 4.5 PS commands a clear premium to every one of these rivals.
And the premium is justified by what?
Higher margins, higher growth, and backlog visibility that none of these names can match. WABTEC's combination of 24.9% EBITDA margin, 13% revenue growth, and a $30.8 billion backlog is structurally different from Trinity or Greenbrier, who are cyclical railcar builders. It is closer to a systems company with software attached.
So the valuation spread tells you that the market is already pricing WABTEC as the quality name in the group. That is not a mispricing, that is a correctly priced premium, which means the upside has to come from execution, not multiple expansion. Let's touch on positioning. What is the options market saying?
Post-earnings, there has been notable call activity at the $280 to $295 October 2026 strikes, which suggests traders positioning for continued upside if the guidance raise plays out. On the hedging side, there are visible institutional puts at the $230 October 2026 strikes. That is classic downside insurance rather than outright bearishness.
So the tape is positioned long biased with protection underneath. That is how institutions sit on a name they like but do not want to ride down if the macro shifts.
On insider activity, CEO Santana surrendered 1,850 shares at $263.40 back in March for RSU tax withholding. That is a routine vesting transaction, not an open market sale. He still holds 312,400 shares, worth roughly $83 million at current prices.
That is the important distinction for listeners. Tax withholding on vested equity is an administrative event. It is not a signal. What matters is that Santana still has $83 million of his personal net worth tied to this stock, which aligns him with shareholders.
Positioning and insider together point the same direction as the fundamentals, constructive, with hedges rather than exits.
Let's pull it all together. WABTEC delivered a Q1 record on revenue and adjusted EPS, expanded EBITDA margin by 170 basis points, grew backlog 36% ex-FX, closed the Delner acquisition, and raised full-year guidance. The bull case rests on 5 reinforcing pillars. The bear case centers on Class 1 CapEx concentration, tariffs, integration, leverage, and CRRC. The valuation at 25.5x forward is fair for a 17% grower with this visibility.
The key metric to watch is freight-adjusted operating margin. It came in at 26.0% this quarter, and it has expanded more than 200 basis points over the past 4 quarters. If WABTEC can hold freight operating margin above 26% through the Q2 and Q3 construction season, while the $30.8 billion backlog converts, the 2026 guidance midpoint of $10.45 in adjusted EPS will prove conservative.
To borrow from Santana himself on the call, and this is the quote that captures the thesis, our backlog growth of 36% ex-FX reflects the secular demand for modernization across every major rail market we serve. We are winning because our customers trust us to deliver not just equipment but technology that makes their networks more efficient, more reliable, and more sustainable.
That is not a quarterly quote. That is a multi-year positioning statement.
The investor takeaway is this. WABTech is not a cheap stock, but it is a high-quality compounder in a sector where quality is rare. Backlog gives you visibility, digital gives you margin, international gives you optionality, and management has earned the benefit of the doubt. If you want rail exposure with operating leverage and a balance sheet that can absorb the next downturn, WAB is the name. For more analysis, visit chargedalpha.com.
Watch freight margin, watch the backlog conversion, everything else follows. This podcast is for informational and educational purposes only and does not constitute financial, investment, tax, or legal advice. Nothing discussed in this episode is a recommendation to buy, sell, or hold shares of WABTech or any other security. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. Listeners should conduct their own research and consult a qualified financial advisor before making any investment decisions. The hosts and Charged Alpha may hold positions in the securities discussed. Thank you for listening.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.